Okay, we're jumping straight into this analysis. Why analysts see 100% upside for Applied Digital.
A really fascinating piece.
It is. In short, it makes a super bullish case for APLD's pivot to high-performance computing for AI, all driven by securing that massive $11 billion backlog and some huge financing wins.
So today we're really focusing on how to make this already aggressive thesis even more robust, even more impactful.
Exactly. So let's start with what seems to be the core theme running through the whole thing, this total reliance on flawless and incredibly fast execution.
Right.
I really like how the conclusion just nails it. It says, the bet is not on finding new customers, but on APLD's ability to build fast enough to serve the ones they already have.
That's laid out perfectly, and it's brilliant, really, to identify that singular risk factor. To explicitly evaluate the risk of construction delays.
Because that's the single biggest operational variable, isn't it? It impacts that entire $43 price target.
It's everything. And I think the material feels maybe a little overly confident in that build-out timeline.
I agree. It does a great job mitigating the financing fear. It cites the $2.35 billion in notes, the Macquarie draw, so the cash is clearly there.
The cash is there.
But it just completely skips the real-world friction. The analysis kind of treats that $11 billion in backlog flowing to revenue as just a math problem.
A math problem, yes. It ignores the sheer challenge of construction at this kind of scale.
Exactly.
And if execution is the only variable left on the table, then the piece has to dedicate some serious time to stress testing APLD's actual building capacity.
Right.
It needs to answer the so what of building 3 massive data centers at the same time.
Yeah, this isn't a small expansion project.
No, it's like betting a Formula One team can build 3 brand new factories in parallel, while still racing. It's a completely different category of operational risk.
Okay, but I wonder, are we asking for a little too much detail here? The audience wants a high-level thesis, not a doctoral dissertation on construction management.
That's a fair pushback.
Is it really feasible to integrate a full sensitivity model without making the whole piece too dense?
I don't think we need a full civil engineering report, but we do need to identify the key choke points and at least acknowledge them.
Okay.
So to strengthen this section but keep it concise, the author could introduce some specific counter-evidence, maybe something related to supply chain issues for critical components, the long lead time stuff.
Like what?
Specifically transformers, switches, those large-scale cooling units. The report mentions Polaris Forge, sure, but what about the availability of specialized labor way up in North Dakota? That's a very real constraint.
So we zero in on the specific bottlenecks. It's not about general construction time. It's about the delivery and installation of proprietary, hard-to-get hardware.
Precisely. A concrete suggestion would be to add a section analyzing APLD's historical performance on similar projects, or even data centers of a similar scale.
On time, on budget kind of metrics.
Exactly. Just focus on the time between securing the money and getting the facility live, and then, crucially, run a sensitivity model.
Okay, show what a 9-month slip, just on a quarter of that $11 billion backlog, what that does to the timeline for hitting that $43 target.
A simple chart or a small table could show that.
Right, and that immediately adds robustness. It moves the analysis from confirming they can build to confirming they can build on time.
That's a great point. That suggestion alone elevates the entire piece because it tackles the only variable that really matters to the stock price at this point. The thesis is all about the speed of conversion.
And this addresses it head on. Which, if execution is the key risk, the next logical question has to be about permanence.
Meaning, if they do manage to build it, can anyone else just build one right next door? Which brings us to their competitive advantage, their moat.
Okay, so let's look at that section on the power problem. The material makes a really strong case that APLD is essential to hyperscalers because it owns the infrastructure and, more importantly, the power contracts.
Specifically for those Polaris Forge campuses in North Dakota.
Right, and this ability to secure massive amounts of power is identified as their primary competitive advantage.
The core idea is solid, but I think we need to sharpen the edges of that advantage. So the second point is this. While securing power is rightly identified as APLD's competitive advantage, the analysis should quantify the cost difference and the long-term regulatory barriers to truly solidify that competitive moat.
Ah, I see what you're getting at. The scarcity of power is sort of assumed, but it's not actually quantified.
Exactly.
Which lets that counter-argument creep in. The idea that a well-capitalized competitor, say an Amazon or a Microsoft, could just replicate this advantage over 5 or 10 years.
What stops them? If they decide they want a piece of North Dakota, what's actually stopping them?
Right.
The moat section needs to move beyond just stating that they secured power. It has to analyze why this specific power access is proprietary and non-replicable.
So is this just a temporary first mover advantage, or is it a permanent structural barrier?
Because if it's temporary, that margin advantage is going to disappear eventually. And that's deadly for a high-growth stock valuation.
So the real question is, how hard is it really for someone else to get in? It's not just about having the money, it's about the regulatory hoops and the physical limits of the grid itself.
Precisely. We have to quantify the scarcity. So to build on that, the author could strengthen the analysis by providing some concrete data.
For example,
Compare the average energy cost APLD secured versus the current industry average for HPC workloads in, say, more constrained regions. That gives us a tangible margin advantage that flows right to the bottom line.
That's very actionable. Show the cost per kilowatt hour difference. Okay, but what about the barrier to entry part?
For that, we need to analyze the specific regulatory complexity, or maybe the grid capacity limitations in those North Dakota locations.
We're not just talking about laying some cable.
No, we're talking about securing the actual capacity allocation from the grid operator. That is often a huge regulatory or transmission bottleneck that's unique to that specific region.
Okay,
The writer needs to show why getting that specific block of power is a higher barrier than just having the $2.35 billion in funding.
are they in multi-decade contracts at below market rates? Is the local substation already maxed out?
Exactly. Is it literally incapable of handling another multi-hundred megawatt load? That's the level of detail that defines how deep the moat really is.
That would be a huge improvement. It transforms the power narrative from just a strong point into a nearly impenetrable pillar of the whole thesis. You're showing a structural advantage, not just a transactional one.
And that flows perfectly into the final section.
Right. So the material wraps up the fundamentals, and then it introduces this short section on technical signals. From what I understand, the argument is that the technical setup is showing really aggressive buying,
Right.
rejecting prices below $20, and establishing what it calls a hard floor of institutional support near $19 on November 24th.
A classic V-shape recovery.
Yeah, that quick, sharp bounce after the news, which definitely gives an investor some comfort.
The analysis of the price action is fascinating, but here's the final point. The analysis introduces the V-shaped recovery and institutional support, but it isolates the technical signals from the fundamental narrative, and that weakens the synthesis of the whole thesis.
I have to push back a little on that. Isn't putting the technical analysis last a pretty standard way to do things? You lay out the full fundamental picture first, the backlog, the financing, the moat, and then you confirm that the market agrees. Why is it so important to integrate them earlier?
Signal in a vacuum. It's real-time, high-conviction validation of the underlying fundamentals.
Okay.
The weakness here is that the material treats the technical data like it's a secondary layer of confirmation instead of using it as primary market evidence.
So it misses an opportunity?
A huge opportunity. It misses the chance to reinforce the conviction level of the smart money, right after that big financing news dropped.
So the signal is basically the market shouting, yes, we believe the debt offering and the CoreWeave contracts solve the execution issue.
Absolutely. The technicals give you a tangible metric of confidence. You want to weave that signal into the narrative to create a much stronger resonance.
How would you do that?
Well, instead of just listing the technicals at the very end, the material could use that $19 support level to frame the conviction around the recent financing events.
So you connect the dollars and cents of the debt offering directly to the immediate market reaction. That would make the whole story much more cohesive.
It stops being a footnote and becomes a leading indicator of confidence.
I see.
The writer should explicitly state that the rapid accumulation seen on November 24th serves as market confirmation that big money is reacting directly to the successful Macquarie partnership and that $2.35 billion debt offering.
So you're providing a tangible, real-time metric for market confidence in the execution of those huge contracts.
Exactly. Instead of just saying analysts are bullish, you're showing that the market itself, through its price action, immediately validated those financial moves. It creates this powerful, integrated narrative that really drives home that 100% upside target.
This has been incredibly constructive. I feel like those 3 adjustments could really turn a strong piece of analysis into a definitive one.
I think so too.
So, to recap for the listener, we've identified 3 major areas for improvement to really maximize the impact of this APLD analysis. First, it has to move beyond that simple backlog execution math.
Right. It needs to explicitly evaluate and stress test the core operational risk of construction delays by focusing on those specific supply chain bottlenecks.
Second, while securing power as a definite strength, the material needs to actually quantify that cost advantage and detail the long-term regulatory or physical barriers in North Dakota to really solidify the competitive moat.
To protect it against those big, well-capitalized rivals.
And finally, the authors should integrate those technical signals, the aggressive institutional buying, that $19 hard floor, directly into the fundamental narrative.
Using them as real-time market validation of the financing and the conviction in those long-term contracts.
Addressing those points will significantly increase the sophistication of what is already a very sharp analysis.
It's a very strong piece of work. It has a clear, aggressive thesis, and refining these areas is going to make the argument nearly airtight. We'd invite you to refine the analysis and submit the work back in for another constructive critique.
We look forward to seeing the update.